بسم الله والحمد لله والصلاة والسلام على رسول الله اللهم علمنا ما ينفعنا وانفعنا بما علمتنا وزدنا علما. Assalamu alaikum wa rahmatullah. Hello everyone. This is the Liquidity Club by Ahmed Shawi. Today is Sunday, the 10th of November 2024. I'll be doing the weekly market review. Now, before getting started, last week we had the US elections. Now, officially, um, President Donald Trump is now back in the office. And because of this, last week was a type of price action that we're expecting a lot of manipulation in the markets. So pretty much I didn't trade a lot. I didn't trade actually last week because of the elections. And it's actually a condition where you don't want to trade because it is a highly manipulated condition or environment that can really cause you a lot of trouble and you can lose a lot of money in these types of conditions. So starting with DXY, here we have the weekly time frame chart. You can see how price opened here last week. We traded all the way down lower here to the weekly fair value gap right there, and then we traded up higher, took out the buy side liquidity, formed this high here, price retrace, and we closed here above this buy side liquidity. Now I'm looking at the premium and the discount wick, and I'm looking at the midpoint, which is the consequent encroachment of both of these levels, respectively. If I want to see price continue running up higher, I want to see price next week on the daily time frame chart close above this level here, very specific level, and I've already also attached it here. You can plot it on your charts. If price closes above this line here on the daily time frame chart, I'm looking for it to be treated as support that can send price up higher to this buy side liquidity and this buy side liquidity. This is will be treated as like a springboard or launch pad. But if we trade down lower, close below the midpoint or the consequent encroachment of that discount wick, I'll be treating this as a resistance. After we close below it, we're treating this as a resistance that can send price down lower towards this fair value gap here. We can take out this side liquidity here and fill the rest of this fair value gap, the BC, and trade down lower towards this BC right there. A BC is an up close candle that has a fair value gap. You can see this is the closing. This BC is formed by this candle's high to this candle's low. It is buy side imbalance, sell side inefficiency. So it's inefficient with sell side delivery. So going to the daily time frame chart, these levels are pretty much nested down from the weekly time frame chart all the way down lower to the daily time frame chart. And this is the buy side liquidity right there, this one. So you can see that we've formed a fair value gap here. On Friday, price tried to run down lower towards the fair value gap, but it didn't. We formed an inside day here, as you can see on Friday. Actually, on Wednesday, we formed this candle here, and then Thursday we formed an inside day where Wednesday's high is lower than, sorry, Thursday's high is lower than Wednesday's high, and Thursday's low is higher than Wednesday's low. And then the same things apply for Friday. We have Friday's high is lower than Thursday's high, and Friday's low is higher than Thursday's low. So it's like two consecutive uh, call it an inside days, two consecutive inside days. So this is pretty much like building liquidity. Price can just run up higher here, just form the wick without closing above this level, take some buy side liquidity and trade down lower, start the sell program. Or otherwise we can just trade down lower, take out and reach to the level again. Maybe we can do some damage by reaching towards this level here, maybe even below to take out this candle's low. It's not a must. It's not that I want to see it. It can happen. So that's why I'm laying down the ground for you to see what I'm trying to expect next week. So price, I'm expecting one side of the market to be pretty much rated. That will tell me what's the other side that I'm going to be expecting. So that's going to be pretty much it for DXY. Going to ES, here I'm viewing the continuous contract and I'm viewing the weekly time frame chart. As you can see, we were expecting price to trade down lower, take out this side liquidity. Now from 1, 2, relative equal low here, and the third touch, you see like two forming equal lows here at this level. So it's very crucial level. You know, a lot of retail traders or the uninformed traders are pretty much trusting this as a means of support level, and we have a lot of liquidity residing and resting below this level here, below this inside liquidity. So I've also drew your attention towards the 6,000 price level right there. and you seen price just attack it last week. This wasn't pretty much something that I was expecting, because I was expecting lower prices in the first place last week, but because of, as I've mentioned last week, we had the US elections, so we were expecting some kind of a movement in the markets. So from here, I don't see, like, I want to see price straight down. You see, I don't see these levels to be left in the market for long. I just want to see price just take them out. If it wants to continue running up higher, if it wants to continue the buy program, at least I want to see price take these out. That's the bare minimum. Going to the daily time frame chart, just like a zoom in version, you can see how price is relatively equal lows. We just touched one more time here. We didn't take out the sell side liquidity. Now, if it price took out the sell side liquidity, I would have said that we might just continue running up higher, but we didn't take out the sell side liquidity here. And once I reach to the NQs, so you'll see also that we didn't take out the sell side liquidity there. So from here, we can just trade down lower, take out the sell side liquidity. Maybe these are going to be treated like an inverted fair value gap, something like this. It's not something guaranteed, as I mentioned. It's not. It's like just my expectations and what I think about the market, because the market's always moving from buy side liquidity to sell side liquidity, from fair value gaps above and below the marketplace. It's always trying to make the marketplace efficient. So now we've raided the buy side liquidity, extended beyond the buy side liquidity, and I've called out the 6,000 price level right there. You can check out the last two weekly reviews. Actually, I've called out the 6,000 price level, and price perfectly just reached there on Thursday. Friday was pretty much a slow day. And then from next week, I'm looking at least to this fair value gap. Price might trade to this fair value gap, or even this fair value gap right there. So this is my drawn liquidity. Like the easiest thing that I'm going to be aiming at is this fair value gap right there, and its respective levels. We have the high, the midpoint, and the low, and you can check the quadrants. That's 25% and the 75% level. The same things apply for this fair value gap as well, or this BC. So that's going to be pretty much it for ES. Going to NQ, here I'm viewing the continuous contract and I'm viewing the weekly time frame chart. As you can see, the same thing is applied or mentioned regarding NQ. We didn't take out the sell side liquidity here. We're just forming lows, as you can see, low, higher low, relative equal lows. And we took out the buy side liquidity. We took the all-time high and we formed the all-time high right there. I believe I mentioned something about the 21,000 level last week. I'm not sure. You can check out the last weekly review and you can make sure what I've mentioned about NQ. But I'm quite sure that I mentioned something about the 21,000 price level. So from here, as I mentioned, I don't see price. It can continue running up higher. But if I was the one who's controlling the marketplace, I know that a lot of traders, a lot of retail and uninformed traders are looking at this as a bullish sign, and we want to see like price just continue running up higher. They will be looking at this like a bullish or bear flag, something like this, and they will be trading this, trying to run up higher. Like everyone is like including their emotions in trading. And since Donald Trump has won the elections and he became the president, they're trying to catch up, and they will just include their emotions into the trading. They'll be just buying everything, thinking that it will just continue running up higher. Whereas, like it will come to a moment where price will just redeliver based on efficiency. That's the main concept of these markets. So from there, looking for price to just trade down lower, take out this sell side right there. That's what I see in the markets. I don't see something. I don't see anything else. It can continue running up higher, but that's not what I see. I see price. It already took the all-time high. So I'm looking for some kind of a retracement. That retracement, at least the bare minimum, is to take out this sell side liquidity. That's what I'm looking at mainly. Going to the daily time frame chart for a bit of a more zoom in version here, you can see how price took out the sell side liquidity right there, and then traded up higher. A stop trade without taking this sell side liquidity. So if we continue running up higher, and we're still in a buy program, by the way, I'm not saying by any chance that we started the sell program, but this is why I say like we need some retracement here at this point. Prices cannot continue and pushing up higher all the time. it has to form some kind of a retracement that can create or engineer the interest in these markets. The interest has to be engineered in the retracement and in the reversals. So if the market is always pushing up higher without giving any retracement or reversals or any consolidation, there will not be there will not be a market to be trading, because the opportunities and chances are born in the retracements and the reversals, all of the states of the markets. When price is just consolidating, it can just expand, retrace, reverse. All of these states in the markets, these are what make the market moves in the first place. So we cannot just suppose that the market is just always going to be pushing up here from here, just continue pushing up here to the 22,000 level or something like this. I'm looking for some kind of retracement. Now, for next week, that my first low-hanging fruit objective is this fair value gap right there. We can include also the volume imbalance if you wish to do so, but that's my main objective. Once we reach there, I'm looking for price wants to close below that fair value gap and reach to the lower fair value gap right there. Now, if price wants to continue running up higher, we have a bullish breaker right there. This up close candle. You can see low, high, lower low. We took out this and then higher high. I wouldn't be trading the bullish breaker. A lot of people would be setting their buy orders just right here, which is the high of that bullish breaker. They can also, or can just move it to the closing price of that candle right there, something like this. But I'm looking for a fair value gap in the second swing, and we have a fair value gap right there, this one. So my order, or if I want to be a buyer, I'll be buying at the top of that fair value gap, or probably at the 75% quadrant level, and having my stop loss like at the rejection block here or this low. This is not by any chance an advice. I'm just stating my opinion. It's never a trading advice or trading signal that you can follow. It's not, it's just something that I'm saying based on my own experience and knowledge about these markets. It's not something for you to go in the markets and trade it. Not at all. It's something for you to just look at it and pretty much tape read it, understand it. That's my main concern about these weekly reviews and all of the teachings. It is about making you able to read these markets better. It's not about you trading them. I don't care what you do with these knowledge, with this information, or this kind of like the experience that I'm trying to pour in these weekly reviews, etc. I don't. I'm not I'm not responsible for any of the actions that you do. My main concern is teaching you how to read the markets. But if you wanna monetize that skill set of reading the markets into making it something that you can trade the markets, it's on you. It's your responsible. If you lose, that's your loss. You're the one who pushed the button. If you win, that's your win. You push the button. I'm trying to be a segue. I'm trying to be the middleman of trying to show you how to read these markets. So I believe that's going to be pretty much it for NQ. Going to EURUSD, also known as the fiber. Here I'm viewing the weekly time frame chart. As you can see, usual price action on a US selection. You can go back in the past and you can see this type of price action here. Price run up higher, took out the buy side liquidity. We opened, traded up higher, reached to the low of the SIBI, sell side imbalance, buy side inefficiency. It's inefficient with the with the buy side delivery. And we traded down lower, took out the sell side liquidity, and we were close of reaching towards the sell side liquidity right there. Now we formed this long premium wick, and I'm looking at the midpoint, which is called a consequent encroachment. I want to see price if it wants to continue pushing up, pushing down lower. I don't want to see price pretty much touch this level because we're really close from the sell side liquidity. It might, if it wants to retrace all the way up here, it can just do some damage with the wick above it. But I don't want to see price anywhere closing just near it. So when I'm looking at these sell side liquidity right there. Going to the daily time frame chart, that's a bit zoomed in. We have this fair gap. Price can retrace towards. Take out this buy side liquidity, reach the sum of the fair gap. We have also here I would say a bearish order block that you can use. And yes, and this midpoint, the consequent also can stop price from reaching above it. So that's going to be pretty much it for Euro USD, or also known as the fiber. Going to Pound USD, also known as the cable. Here I'm viewing the weekly time frame chart. You can see that Pound USD wasn't really affected with what happened with the US elections. It's not that it didn't affect it at all, but we didn't see the type of price action that we saw in the other markets like the XY or the other markets. So now it's like just retail traders or the uninformed traders will call this a doji, but we're not looking at the candles here. We're just looking with the wicks. We have the premium wick and the discount wick. I'm looking which will be respected more that I'm going to be deciding. Honestly, I want to see prices trade down or take out this side liquidity. Also, if I want to see it do that, I want to see price trade down lower on the daily time frame chart, trade below this level, close below it, and treat it as resistance that can push price down lower towards just tank down lower towards the sell liquidity. Going to the daily time frame chart, you can see it's just a seek and destroy. Took out the buy side liquidity here, and we took out the sell side liquidity there. So it's just like a seek and destroy. We might like form some kind of consolidation or the holding pattern, and then we can take out one of the markets, one of the sides, either the buy side liquidity or the sell side liquidity, and then reach to the actual drawn liquidity. So we're still sitting on our hands, we're just sitting on the sidelines, pretty much demanding more intel from the markets, especially after last week, which we had the US elections. So I believe that's going to be pretty much it for this weekly review. I really hope you found this one insightful. If you have any questions, don't hesitate to ask them. Until I talk to you next time, be safe. Wassalamu alaikum warahmatullahi ta'ala wabarakatuh.